Hey there, and welcome to Chapter 2 Wrap-Up. If this were an in-class class, there are several main concepts I would be sure you left with, because all chapters build on Chapter 2. Give me a moment to bring up the whiteboard, and we'll do a quick demonstration. The objective 1 in Chapter 2 is to define accounts and understand how they're used. Let's back up a bit and establish account types first. Account types are assets, we'll represent that with an A, liabilities, an L, equity, revenue, and expense. Think of each of these this way. Assets are what you own. Liabilities are what you owe. Equity is the difference between what you own and what you owe on what you own. Revenues are what you earn. An expense is what you incur in the process of earning revenue. Written out like this, we can quickly add the equal sign, the pluses, and the minus to demonstrate the accounting equation. When we look at the accounting equation, we see two sides, a left side and a right side. When accountants talk about left and right, they use the terms debit and credits. The golden rule in accounting is that debits always equal credits. So anything you do to the left side or debit side, you have to do an equal amount to the credit side. If you don't, it's out of balance, and that's not good. Each account type has accounts that belong to it. For instance, assets have an account called cash. Your car could also be an asset. If you owe money on your car, you have a liability called loan payable. And the difference between what you paid for your car and the amount you owe on your car is the equity you have in your car. Notice how the left debits equal the right credits. If you use your car to earn revenue by driving for a ride-sharing company and incur the expense of fuel, those accounts would be under those types also. So let's add those. If we earned revenue by driving, that would be under revenue. If we incurred the expense of fuel for the car, that would be an expense under expenses. Let's say you earned $1,000 revenue driving, and they paid you in cash. You would put $1,000 on the left side of cash and $1,000 on the right side, credit side, of revenue. Let's say you had to pay $500 for fuel to earn that $1,000 of revenue. The fuel expense would be a debit, and if we used cash to pay it, we would have a $500 credit on the right side of the cash account. The reason we use T accounts, or T's, to represent accounts is because a T has both a debit side and a credit side. So if we were to trade one asset for another and only affect the left side of the accounting equation, we would be able to keep the whole equation in balance because we could debit and credit our assets. For instance, if we bought a tool for our business that costs $250, we would debit that asset tool and we would credit the cash that we used to pay for that tool. Notice we're still in balance. Let's talk about balances, and most importantly, normal balances for a moment. This is very important and usually breezed over. What normal means in accounting is where you expect to see the balance of an account. Looking at our cash account, if we add up the debit side and then add up the credit side and subtract one from the other, we would have, let's add them up here real quick, 1,000 on this side, 750 on this side, subtract one from the other, we would have $250 on the debit side. We expect to see balances of assets on the debit side. We expect to see balances in the other account types as so: liabilities on the credit side, equity on the credit side, revenues on the credit side, and expenses on the debit side. So if you remember, the two outside account types, assets and expenses, are on the debit side, and all the ones in between are credits, you're golden. Lastly, let's look at journal entries. The proper format for a journal entry is to write the debit on the left margin and indent the credit just a little bit so it's set off to the right. In this entry, I'm going to debit cash, and I'm going to credit the driving revenue. Oops. Forgive my spelling. As I did in the T account. So we're going to have $1,000 here. We're going to put $1,000 here. This is the debit side. This is the credit side. And if we trace that back up, here's the $1,000. Here's the debit, and there's the credit. Now let's record the fuel expense. Since the fuel expense is a debit, we're going to put that on the left margin. And since we used cash and we credited cash, we're going to credit that. So we're going to have $500 debit of fuel expense and a $500 credit of fuel expense. And we'll demonstrate that here in just a moment. Let's see, here we go. Here's our fuel debit and our fuel credit, just like the others. Now let's say you provided a ride and your passenger paid you half in cash, half on a credit card. The entry would look like this. You would debit the amount of cash that you received, debit the amount you're going to receive in accounts receivable, and you would credit the revenue for the full amount. So let's say they give you $50 in cash. They owed you $50. You're going to receive that from the credit card company, and the total was $100. And remember our golden rule: debits are always going to equal credits. Please be sure and read about the accounting cycle, because we're going to use that again and again and again. I hope this helps, and please don't hesitate to email with any questions you might have. All right, goodbye.